Here's what the gold market did this week, and it just hit $4,113 an ounce. Gold is not slowing down. It is not consolidating. It is grinding higher week after week, and most investors still have no idea why. Here's what the gold market did this week, why it happened, and what to watch next week. Let's start with the headline number. Gold closed this week at $4,113.70 per ounce. That is not a typo. At the start of 2024, gold was trading at roughly $2,063 an ounce. That means gold has gained nearly 100% in under 30 months. To put that in perspective, the S&P 500 over the same period is up around 30%. Gold has more than tripled the return of the most widely watched stock index on Earth. If that doesn't stop you in your tracks, I don't know what will. So what drove this week specifically? Let's break it down. The macro backdrop this week was dominated by three major forces. First, the federal funds rate is sitting at 3.63%. That sounds like a decent rate, but here's the thing, when you subtract real inflation, you are not earning as much as you think. The US CPI index currently sits at 333.979. That index started at 100 in 1984. That means the purchasing power of the dollar has been slashed by more than 2/3 in just over 40 years. Every week that passes without real rate relief is another week gold's case gets stronger. Second, US real GDP growth came in at 2.1%. That is not a disaster, but it is not exactly a roaring boom either. 2.1% real growth in an economy that is running a federal deficit approaching 7% of GDP means the government is essentially borrowing growth from the future. The Congressional Budget Office has projected the national debt will exceed $50 trillion by 2034. When you borrow that aggressively just to produce 2.1% growth, that is not economic strength. That is a slow leak. And gold prices that long-term leak. Third, and this one is huge, the bond market is flashing a warning signal that most mainstream outlets are ignoring. The best CD rates this week are advertising up to 4.1% APY. That sounds attractive. But CDs are time-locked, dollar-denominated, and they carry credit risk that gold simply does not. Gold has no counterparty. No bank needs to stay solvent for your gold to be worth something. CDs cannot say the same. Now let's talk about what actually moved the market in specific terms this week. Gold opened Monday just under $4,080 and by Wednesday had pushed through $4,100. That $4,100 level is significant because it was a ceiling that the market had tested 3 times over the previous 2 weeks. Breaking and holding above it is a technically bullish event. Chart technicians call this a resistance flip, meaning a level that was hard to break becomes a floor of support. The close at $4,113.70 means gold is now sitting comfortably above that former ceiling. Here is a data point most people miss. Central banks globally purchased over 1,000 tons of gold in each of the last 3 consecutive years, according to World Gold Council data. That has never happened before in recorded history. 3 years in a row above 1,000 tons. Central banks are not buying gold because they think it's a nice shiny rock. They are buying gold because they are quietly de-dollarizing, meaning they are reducing their reliance on the US dollar as a reserve currency. When the institutions that print money are buying the thing that can't be printed, you should probably pay attention. Let's shift to what's ahead next week. There are at least 5 specific things you need to have on your radar. Number 1, US CPI data. The next consumer price index release is due in the coming days. Analysts are forecasting a month-over-month reading in the range of 0.2% to 0.3%. If inflation comes in hotter than expected, gold could spike fast because it reinforces the idea that the Fed is behind the curve, meaning they have not tightened enough to actually kill inflation. If CPI comes in cooler, watch for a short-term pullback in gold toward the $4,060 to $4,080 support zone. Number 2, Fed speaker appearances. Multiple Federal Reserve officials are scheduled to speak next week. The market will be parsing every word for signals about whether a rate cut in September 2026 is still on the table. Right now, futures markets are pricing in roughly a 60% probability of at least one rate cut before the end of 2026. If that probability moves higher, gold moves higher with it. Rate cuts reduce the opportunity cost of holding gold, which means gold becomes relatively more attractive compared to savings accounts and bonds. Number 3, the US dollar index. Gold and the dollar tend to move in opposite directions. The DXY, which measures the dollar against a basket of 6 major currencies, has been weakening through much of 2026. A further drop in the DXY below 99 would be a significant tailwind for gold. Watch that level closely next week. Number 4. Geopolitical risk. The Middle East, Ukraine, and rising tensions in the South China Sea remain active pressure points. Geopolitical uncertainty is like rocket fuel for gold. In April 2025, when US-China trade tensions peaked, gold gained over $300 an ounce in less than 6 weeks. Any escalation next week could trigger a similar fast move. Number 5. Technical levels to watch. On the upside, $4,150 is the next key resistance. That is where a cluster of sell orders from short-term traders is likely sitting. A clean break above $4,150 opens the door to $4,200 and potentially $4,250 before any major pullback. On the downside, $4,060 is critical support. If gold breaks and closes below $4,060, that would suggest the short-term trend is weakening and we could see a flush toward the $3,980 to $4,000 zone. Do not panic if that happens. It would be a healthy correction in an otherwise powerful bull market. Here is your weekly scorecard. Gold this week, up, closing at $4,113.70 per ounce. Federal funds rate, 3.63%, unchanged. US CPI index, 333.979, still elevated. Real GDP growth, 2.1%, steady but unspectacular. Best CD rate available, 4.1% APY, which looks appealing until you account for dollar debasement. Central bank gold demand, historically unprecedented for a third straight year. Technical posture, bullish, with gold holding above former resistance at $4,100. Balance of risks for next week, skewed to the upside unless CPI surprises to the downside or a major risk-off event causes short-term liquidation. The bottom line is this: gold at $4,113 an ounce is not a bubble. It is a barometer. It is measuring the exact temperature of a global financial system that is running deficits it cannot close, printing money it cannot stop, and accumulating debt at a pace history has never seen. The people who dismissed gold at $1,800 are the same people who will chase it at $5,000. Don't be that person. If you want this kind of weekly intel every single week, hit subscribe right now. Every week on this channel you get the exact price levels to watch, the macro data that moves gold, the central bank flows nobody else is talking about, and a clear-eyed scorecard so you always know where you stand. No noise, no hype, just the numbers and what they mean. Subscribe, hit the bell, and I will see you next week.